We have NFP today, so it's going to be a very important day, and I really hope you all remember what I told you after Yellen spoke. This NFP is going to be extremely important. The importance of it lies in fundamental factors, but also technical factors. Yes, Lisa, it is good. It's 1st of April, a whole new month has started, so the best thing about ending a month on a Friday is that we have the whole weekend to review our previous month and obviously plan the new one. So planning and also review are two essential skills that we as traders and investors need to have. So yeah, I'm going to be talking about a few things today, and I'm going to explain to you a moral that most people use, especially in times of uncertainty in the financial markets and not only. I'm going to connect this with a couple of different things. I'm also going to explain to you technical factors in the market and the importance of them that lies today. Today is an extremely important day in the markets, and I'm planning not to waste too much time. So I'm going to just quickly go over a couple of things. And the first thing I want to teach you all is well, first of all, I'm going to teach you how natives of Africa and Asia use a technique to catch monkeys, and they've used this for thousands of years. Now, what basically they used to do is they would find trees in areas where monkeys would stay around, or where would they live. They would take fruits, vegetables, things like this, and they would glue them together. Well, they would put them inside a hole, okay, and then they would glue them together. Now, when the monkeys would come along, obviously the people would leave. The monkey puts his hand inside the hole, grabs onto the fruits, and the monkey's fist, basically, which is now holding on to the fruits, which are glued together, his hand is full of these fruits, and when he pulls his hand out, he cannot withdraw his hand from the hole because his hand is pretty much trapped. The monkey can obviously let go of the fruits, and he's going to be fine and can walk away, but the monkey doesn't think like that. So rather than letting go of the fruits, the monkey keeps twisting, keeps turning, pulling, trying everything, but refuses to let go. Now, obviously, the people would return, and at their leisure, they would either kill or capture the monkey. Where we are similar to this scenario here is that we humans are, just like monkeys, holding on to many different things, such as job securities, our possessions, relationships that kill us, or even money. Referring to traders and investors, people who lose massive amounts of money in this industry are the ones that hold on to losing trades, hold on to very bad habits that pretty much just destroy them as traders or investors. And yeah, that's pretty much exactly what I'm trying to explain to you here. Now, holding on to something that's bad for you is a total habit of human emotions. We do this all the time. We do this with cigarettes. We do this with alcohol. We do this with nerves. We do this with spending. We do this with speeding. We do this with talking. We do this, talking behind other people, for example. These are all bad habits that we hold on to, just like the monkey's holding on to the fruits. It releases a neuron in our minds, which makes us feel good at that time, or just a habit, and we just pace through it. So basically, due to lack of financial and investment education, like the trapped monkey, most people will spend their lives as either wage slaves to their employers, or tax slaves to the government, or losers in the financial market. The reason, and this is one of the biggest reasons there are so many losers. I see it over and over and over again. People open a trade, they don't put a stop loss. They think that because they have some special feeling in their mind, or in their hearts, or in somewhere, they think that trade is going to be a winner. If you watch our Facebook posts on that page, Pips Matter, you will realize that there is a lot of information released on those posts. For example, this morning, we released that the most important rule of trading is to play great defense, not great offense. Yes, not great offense. So basically, the idea with this is that Risk management, and I'm going to talk about this over and over and over again, is truly the key to your success in the investment world. Now, why is it the key? Because it is based on a few rules that will not allow you as a person to let your emotions get into the way. I don't care how certain you are that the trade is going to go down. I don't care who told you that it's going to go down or up. And I don't care how many technical, fundamental, or who's whispering in your ear that something's going to happen. You need to protect your capital. But most importantly, you need to feel comfortable with losing that amount. That's the first thing you need to be comfortable about, the defense. Okay? The defense of your investment is much more important than making money. So protecting your capital is the most important rule that we can have when it comes to trading or investing or buying a house or buying a car or going out and spending money or buying a present or anything else. You need to think like a winner, and a winner thinks, how is he going to you know that saying, you may have won the battle but you have not won the war? Well, basically that's pretty much what I'm trying to explain to you here. You can lose many battles but end up winning the war. And I can tell you, wars are based on quarters and years in the investment world. So there are people who lose 70, even 80% of their trades, but end up coming winners. It's not about how many you win, it's how much you make when you win and how much you lose when you lose. So this is called protecting your capital. I'm telling you that with the right system, you can lose 9 out of 10 trades, or 90 out of 100, or 900 out of 1,000, or 9,000 out of 10,000, and still be way ahead. And I'm talking about 3, even 4-digit percentage returns. They're all possible, and it's been done before. So, let me just see if we have a question. Oh, I'm very happy about this, Lisa. I'm very happy. They're going to continue. There's so much more that's going to be coming there, and that's a project that is going to be really turning. Well, it's going to be a game changer. It's something that nobody else can do in the financial markets, because the passion I believe that I have for the business and my team has for the business exceeds many other people's. And I'm not trying to put anyone down. And I don't mean by you guys, I mean by brokerages and investment mentors and things like this. We have a massive passion to help others succeed, because the logic behind our business philosophy is that if we can help enough other people to get what they want, we can get what we want. Do you understand? So, let's go back to the monkey. Due to lack of financial investment education, most people, like I said, will end up working for someone else their whole life, being scared of taking chances in their life, and pretty much do the same thing every day for 40 years, or basically every year for 40 years, and call it life. It's not like that. Now, when the global financial crisis began in 2007, and many people remember this one because it was a really big one that's still holding effect, even though people couldn't afford to pay off their houses and loans, many people still, well, what they did was basically they got stuck onto their jobs even more tightly in hope of not being one of those people that got laid off. Now, millions of people holded onto those homes, even though they could not even afford to pay mortgages. Instead of cutting on your losses and at least having some capital, millions of people lost their homes, got destroyed, and what most people did to fight this was they cut their spending and started saving more. But when your interest rates are so low or negative, you're actually playing in a game that you can't win. Even if you have 100 million in your bank, negative interest rates will just keep cutting your money away. And I told you this last time, they are designed. So how do they? Central banks basically control the pace of our economies. When everything is good, they start increasing the interest rates, okay, at a rapid pace, not once a year. They start increasing the interest rates, which allows people to save more, okay, because it makes sense. If your interest rates are higher, people leave money in the bank yearly, on a yearly basis, you receive something back at least. When the interest rates are low or negative, then you're losing money as a saver. Every year, you're losing and losing and losing. Even though it's a small percentage, it adds up. compounding. It just keeps compounding into a massive ball of a loss. So what does this make people do? This makes people withdraw their investments and start spending more. And by spending more, they increase the economy, and that's how it goes. So what most people did, and what most people do in times of uncertainty in the financial markets or economies, people hold on to things that are pretty much liabilities. So basically people start saving more, even though the federal government of the US or pretty much most central banks in the world, or all, were printing trillions of dollars. And what does printing money do to you? It destroys the purchasing power of your savings and your earnings. Your money becomes worthless. Do you know how much value the dollar has lost since 1974? A lot. And this is called inflation. It keeps going up and up and up and up. And in 100 years, our kids and our grandkids, are going to go into a shop and spend $1,000 and it's going to be normal. And this is just because of inflations. And printing money. So basically what's going on in the industry is this. People cut on their spending and start saving more. Even though, like I said, the government started printing trillions of dollars, which destroys purchasing power of our savings and our money, workers stuffed even more money. People who work basically stuffed even more money into their retirement plans. And where are retirement plans? They are basically invested with different hedge funds. And most hedge funds invest in the stock market. And what happened to the stock market? Crashed massively. And the people who were investing their money for them were wiping out their prior gains constantly and even losing people's money. So what happens to your retirement money? It goes poof, just disappears. So instead of retiring healthy and fine and have enough money to live the rest of your life, many people at 60, 65, 70, and even 80 had to find jobs. And whose fault is it? It's not their fault. It's other people's faults. But it's our fault in essence that we did not financially educate ourselves to a point where we manage our own money. We control. And I don't mean in Forex. I mean in everything. So what I'm trying to tell you here is that you need to get financially educated. You need to know how to manage your own money. You need to know how to make sound investments so other people can manage your money. But most importantly, financial education must be increased. Nobody taught you financial education in school. Nobody taught you how to deal with your problems in school. Nobody taught you how to deal with the challenges of work and so forth. And yet people spend hundreds of thousands of dollars on education that's pretty much worthless and outdated within 2 years. Now, most people did not know what to do after 2007. They were lost by 2010. They all knew that there was a massive global financial crisis, but unfortunately, most people did not know what to do about it. So rather than letting go, most people clench their fists tighter and wait for the crisis to pass, praying that their political leaders can solve this global crisis and that the happy days will pretty much return back. A few know that they must make changes, and few, I mean a couple of percent. Yet without financial education, they do not know what to do or how to change. Now, this is why we're very, very pro-education. And I don't mean just education, things that... I'm never going to talk to you about things that are never going to help you. There's no reason for these things. The things we teach here are things that 100% of the population should know. But unfortunately, most of the population, especially, many people don't want to learn. They like it easy. But easy never made anyone money. And if it did, it's most likely not true. So I'm just going to go into today's trading, not to take up too much time. Here's what we have in store for today. Today is April 1st. We're beginning a whole new month, and it's going to be a very important one, just like February was, and March, and January, and every other month of the year. I told you all 2 days ago that technically, long term, I have reason to believe that the US dollar is going to be very weak this year. This, however, does not mean that on a short-term basis it will be weak, because currencies such as the US dollar and euro, GBP do not lose value so rapidly. Rather, just like every trend, they will give you the signs on daily and weekly moves, or better, in other words, higher highs, higher lows or lower lows, lower highs, basically creation of a trend. I explained to you, and we're looking here at the daily chart of Euro USD, and here's this big move over here. This is when the dollar really gains strength. So if we look at this in an A to E move, we will start with the A being here. We will add the B here, and I'm going to explain to you what we're doing. B, C, D. We need an E now, but an E will not be created like this. We're using much higher and rapid moves in the market. We can even count this as an E, but I prefer using the top over here. So what I'm trying to tell you here is that long term, I really have reason to believe that once these levels are broken here, especially the white line, we're going to see Euro USD pretty much climb to the 124 area pretty fast. So somewhere here in between 122 and this 120, basically 125, somewhere there. Now there are very good chances that the price will not break this level yet, and I will explain to you in the shorter time frame of the ABC. It will help you understand that there is chances of pretty strong growth today from the non-farm payrolls, but also I want you to keep in mind that statistically you cannot have, and normally even in a rising economy we don't have like many consecutive months of very high retail figures. So I mean for the past, since November, we've been hitting basically 200 plus K, even coming to close to 300,000 jobs being added. Now, only in February we dropped to 151, and then last month we just shot back up to 242. We can see red figures today. They probably will be decent, but I do not want to speculate in something like this. I want to speak to you technically what can happen. Technical setups are indicating to us that the dollar will probably be strong on the short term. And even if we look at GBP USD, even USD CAD, if we go on the daily chart, we'll see a double bottom. And these figures are indicating to us that we probably will see the dollar rise today before losing strength again. So we can see it drop down to the 50% area of our, somewhere here, 111. That's about, well, not really today, but maybe, we'll see. In the short term, we can see the dollar drop. I'm not telling you to start selling right now. You need very good risk appetite to take chances on NFPs and big events. So if you, like I told you, you need to lower your risks today. And what I mean by this is I need you to have bigger stops and smaller positions. Don't risk it. It's just one day. Okay? Today is just one day of many that exist in the markets. So if you're willing to risk it all, just so you lose everything and then you can just trade on a demo account, I don't think that's wise. Right? Unless you're planning to make 1,000% today, don't risk 100% of your capital. If you're not planning to make 500% today, don't risk 50% of your capital. That would be insane. That's financial suicide. Even if you have $50 in your account, protect it. It's your money. It's very important to grow that money as well. So, what am I trying to tell you here? I'm trying to tell you that technically speaking, we can see a strong dollar today. And let's go down to basics over here, and I'll just put the line charts. See, if we look at from the medium term level, A, B, C, D, E. Now, this does not mean that price will drop down. The E means something on the contrary. This is a triangle, and triangles work amazingly on A to E levels. So once completed, triangles normally lead to very aggressive breakout moves. Normally, they have, about 5 consecutive waves, which we're labeling right now of A to E, okay? A, B, C, D, E. We're labeling them from there, and once E finishes, the triangle usually breaks out either higher or pushes lower. So triangles are normally continuation patterns, but they also reserve trends. Okay, so we can have a breakout and create a whole new trend already from today. This doesn't mean that price will just go up, 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 up. This means that price will go down and up. And these are daily charts, so these are massive numbers, even at the size of my mouse. Today's data can push the dollar all the way up to 115 Euro USD, or bring it down to the 108 area. And I'm talking short to medium run. To me, short term is days, okay? 1 to 5. Medium run is weeks, and long term is months and years. Now, since we do not use any kind of fancy indicators here, we definitely have no pills that turn us or make us limitless, and we really have no secret sauce. There is no secret sauce here. We never had such gifts. Believe me, we tried. We tried not pills and not sauces, but indicators and systems and blah, 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 and they all lost us money. So they did the same thing exactly for anybody else that has used them. What I'm trying to tell you here is that we had to learn to trade the professional way. And what I mean by this is price patterns, volume analysis, psychology, a few trading rules, and other factors such as mathematical points of interest. All of these things created what we call today our trading system. So before we go into anything else, let's remove our yellow lines. Let's add in our mathematical points of interest. I mean, I'm very pro as well. Pivot points, you can use them as well. They're pretty useful if used correctly. So you need to really study them, and you should not read them from. You shouldn't get them from some silly website where somebody's trying to charge you for some nonsense. Okay, so let's take a look at the chart now. Just bear with me a moment, everyone. I'm almost done with this. So for anybody that doesn't know what I'm doing, I'm actually adding mathematical points of interest, and this is the 12.5 level added on. So 0 plus 12.5 is 12.5, 12.5 plus 12.5, 25, 25 plus 12.5, 37.5, and so on. And what I'm doing is just leaving the 50% levels of 50% and 150. Then I'm going to duplicate this object, and I'm going to re-add it over here, and I'm going to duplicate it again, and I'm going to re-add it over here. Oops, we made a mistake, so right there, and right here. Go to the daily. So here's our 50% level. We're very close to it, and you can see that it has worked pretty well the last couple of times. We have one abnormal move over here, and I'm sure you all remember this. I think it happened in August, if I'm not mistaken. This was when the Fed did not raise interest rates. It was actually the FOMC minutes that made this go crazy. And right about here, yes, it was in August. It must have been in August. So you can see that 50% level working really, really well. And if I re-add another 50% level between this and this level, we will get the price where we are at right now, right? So here we go. And I'm just going to change the color of this. Actually, I'm going to make it dotted and turn it purple. So you can see price stopped right at this level before, used a couple of times before in the past. And we can also see price coming to the next level and breaking back down or closer to it. So I'm making this very clear. These are areas of interest and not prices. Areas of interest. That means that price might come to this level, break it a little bit, and go back down, or break all of them very rapidly. How do we understand this? Well, that's going to happen in our next lesson a bit more, and that's based on volume. Okay, volume analysis will tell you a couple of things, but I'm gonna continue talking about this. Now, since most major pairs right now are at key levels today, and ironically we have the NFP today as well, I will tell you what you should use to determine if any of your trades that are currently open should be kept open. Some of the criteria we use to basically determine if we're in the right positions or if we should open the right positions is 1, increased volume on a breakout. We will only understand this once a breakout begins to happen. So pay attention to this. We have a few very important reasons to believe that price will go down. But I'm pretty sure you guys remember the other what's it called? One of the rules. For example, rule number 19. Never buy because the price of an asset is low, or sell just because the price of an asset is high. Now, I need to add on to this rule, and I'm adding on, never sell just because price is at the trend line, what's it called? Mathematical point or anything else. Don't just do it because of this. You need a few more reasons why you should be selling or buying. Now I'm going to explain why volume helps you. When price comes to this area here and it starts breaking, the NFP comes up really bad and price starts breaking this level, you need to pay attention to volume. There are a few ways to pay attention to volume. You can even have tick volume from the map, okay? And once it rises above 50, that means that's pretty good. Or basically where price is going, you need to look at volume. Tick volume helps you, but I recommend going on a shorter time scale and looking at it like this. Even the daily chart helps you, but as you see, I don't like this like this. You need to get a better volume indicator. Let me just see if I have something here. Okay, something like this. Something like this would help you. Okay? Something like this would help you more because then you would understand a little better what can be happening in the markets. And I want you to add this onto 50. Just right click it and type in 50. Well, actually, a few more zeros need to be added. Okay, there. Okay, so once price is below that, that means the volumes are not pretty strong. And forget about the colors of red and okay, so I just want you to pay attention to volumes. So once price came here, I want you to look at the volumes of the reversal. These are daily charts, so as you see, the volume remains high. Volume is abnormal here. As you see, it's very small and then very rapid, but it's also rapid on the down. So you need to connect here candlesticks, okay, direction. So I'm summarizing candlesticks with directions, and the volume of pairs. Price came to this level here. As you see, it did not break the 87.5. It came to it and started going down. Price starts going down, volume is increased, And here, right where we are right now, volume decreases rapidly. That indicates that there is not enough momentum to continue going down. But volume analysis will be explained a little bit better next time. And as you see, price closed right between our levels here. And I'll find you a better indicator for volume so you can understand volume a little bit better. But again, increased volume on the breakout is an indication that there is a very good chances of price heading higher. Once a breakout happens, the first few days after the breakout, price should move in the direction of the breakout. So what I mean is this here. I'm going to explain to you. I've told you about normal and abnormal moves. These are daily charts. 1, 2, 3, 4 days up. Okay? 4 days up. Breakout happened. Next day, bam, down, down. That indicates that this is an abnormal move, and we clearly determined that price will not break this level. So you could have solved right about that point. At point number 3, it will be very important to look at the volume of the move. If in the retracement the volume is low, this will be a normal sign that we are in an unlegitimate breakout. So if the volume is low, this is increasing, and the volume is decreasing, then we can see price pretty much go to the normal, into a normal breakout. And the last point that I want to tell you is that volume should be higher in the direction of the trend, but not necessarily. It should only be higher once we're breaking our points. Okay, look at this here. We have up, volume's up, and then when we came to this, the volume decreased drastically and price went down. Okay, so deviations from these patterns are pretty much warning signals, and if confirmed by price movements back through the mathematical points or even pivot points, if you might use them, this will pretty much indicate that unrealized profits should be taken. And what I mean by this is, if you're going long from here and you're really expecting price to break this level, but you realize that volumes are even here dropping, not only that, but a few other factors as well, basically you should take your profits or cap them in by adding a stop loss in profit, which is the thing that I recommend. So timing the market, this is what I want to tell you now. Most professional traders know that being right just a little too early or a little too late can be as bad as simply being wrong. Timing in the financial markets, especially Forex, is crucial, and pretty much nothing provides better timing than price itself. So you need to understand how price works. The pivotal and mathematical points mentioned occur in FX pairs, but also in most commodities, stocks, and indexes. What I'm telling you right now is let price confirm the trade before entering a position. I recommended to you quite a few times to have a checklist of trades. What I mean by this is 1, 2, 3, 4, 5, or 1, 2, 3, and basically look at patterns, look at the markets, really understand what's actually happening. And the best way to understand it is to study history. What I believe here is that no matter how much we feel that we know what is happening, we actually need to wait for the market to confirm our idea. And only when it does, we should be taking our trades. So having instinct is of course important, but having instinct is sometimes can be compared to gambling, and it is, and it will be. Timing is much more crucial here. Instinct is important, and the way to control your instinct is to have rules. The 23 rules we use are valid today and will be valid tomorrow and will be valid for the next decades to come. There is a very famous investor, his name is Jesse Livermore, and he said the following words: there is nothing new on Wall Street. There can't be, because speculation is as old as the hills. whatever happens in the stock market today has happened before and will happen again. That means that, well, you know what it means. It means time repeats itself. So, I'm explaining to you here today that there are always two scenarios in the market. Price can go up, price can go down, or price can go sideways, which is basically up, down, up, down, up, down, up, down, like here. But as you realize, and as you may notice, the following. Price is actually coming closer and closer, and we can see this pretty much here. Like I said, normally price works on A2E moves, and we can pretty much see this price relaxing in these areas and actually coming much tighter inside this triangle. And this is indicating to us that a move is coming, and a big one is coming. Now, whether that move is normal or abnormal, it's for the market to decide, but I think a normal move should come soon. And what I mean by a normal move, I mean price is going to either shoot up or shoot down rapidly. We could see price go down today and then in the coming months break these levels here and head from the 62.5. Actually, that's not the 62.5. Just a second. Just a moment. I just connected the chart too close to. Does anybody have any questions while I'm doing this? Well, Matthew's asking about order flow and supply and demand. Yes, of course, our order flow and supply and demand are essential, but this falls under the fundamental analysis right now. And I'm telling you that fundamentals right now, at least, like I said, I have reason to believe fundamentally, I believe that the US dollar will be weakening in the long run. The short run, I can't tell you. There's just too much information going on now. So fundamentally, I can't really tell you what's going to happen. It's basically a wait and see game with that. But long term, definitely, I believe that the US dollar will be very weak this year. So just a second. But Matthew, what are you asking specifically about supply and demand? I don't really understand why you're asking about this, and can you just elaborate your question a little bit better? Hi, Marius. You're welcome. You're welcome back. But you didn't really miss that much, and it's being recorded. I didn't know these trades were open before, and basically I'm using the profits from other trades to cover this. To cover these trades, so it's and I'm actually going to add my trailing stops in. You don't have to follow me on these trades. I really do not recommend anybody to follow me on these trades. So once again, I'm telling you the following. We're looking at a very interesting technical setup on Euro USD. We have another one on GBP USD, and I'm going to move to that pair right now. And show you excellent indications that we can pretty much see a reversal occurring soon. You can see that the candles have touched this area already. And we're also on the A to E move here, and I'm going to show you this right now. A. So A, and then we find our bottom. You can see abnormal moves on the bottom, but if we add this here, you can see that price pretty much stagnated and stopped around these areas a few times. And then we can add a trend line for this, which is pretty, again, indicating to us that we can see rapid moves come out of this area. So I can use this as A, B, C, D, E. Price is already heading down, and I believe a few of you should have taken these trades. We sent this out as a sell, GBP USD, and we sent Euro USD. Euro USD shouldn't be in a profit yet for anyone because it did shoot up to that area, but it looks like it will head down today, and GBP USD is already going down. Now, so I've given you this here, and I'm going to USD CAD. And we can see a stop at this level here, 128.4. You can see it here work as a very decent support. Once broken, used as another resistance, and then used as a support to bounce off for this very rapid move. And then we can use the same idea here of A, B, C. We go up, D, and then down, E. And yeah, pretty much move from there. You can also see USD JPY at a really long, and this is a very long-term idea. So let's just go down to the daily chart, and then I'm pretty sure we'll find the reason that we could use to buy or even sell the USD JPY. So we have a flag formation. Well, this is really volatile. It's becoming much more volatile. But anyway, we can see technical patterns. Like I said, short term, strong dollar, medium term to long term. So short term, we could see a stronger USD. Medium term, so I'm talking days. Days is short, medium is weeks and months, so week. And then long term, definitely weak. Now I want to explain to you something. Normal movement in the markets are when Janet Yellen, for example, comes out and weakens the dollar significantly, and then just a few days later is the NFP, and then the NFP normally is stronger, and then it evens out the currency. You will not find many cases, and these are abnormal cases, when Yellen or something else or some other factor is going to come and weaken the dollar or strengthen it, and then a few days later there's some economic data that's already expected to come out, and then it does exactly the same thing. Let's say, for example, in this case, weakens it. Not that it doesn't happen, it does happen, but when it does happen, and I explained to you that normal and abnormal movement doesn't happen in short periods of time, and I mean short in this case, I mean days, weeks, and even months. It happens once, two, 3 times a year, let's say. Abnormal movement. Again, abnormal movement is something that everybody expects not to happen, and it happens. And for example, today it definitely looks like the NFP is going to be stronger. But again, don't take my word for it. That doesn't mean you should just open positions, but you should be ready for something. And when I mean ready, that doesn't mean that you should just open positions once the NFP comes out, because in many cases, when news data would come out, retail traders would just look at that specific number. I'm pretty sure you guys remember a few times the data would come out and it would be really bad for the USD, but the USD would kick some ass. And I remember people asking me about this, why is this happening? And then I'd have to explain to them that, just like in last session, I told you that you should really understand an economy and study the charts and the reasons why things are happening. Then, when you do that, you will understand that even though in February the NFP came out 151, the economy still grew. Everybody else saw a red big figure. Oh my God, we dropped from 292 to 151. How many people started selling that? February 5th. Let's get February 5th. I just want to show you what happened. And even though the NFP came out pretty weak, so here's February 5th, Euro USD. And this is the NFP, this candle here. Okay, this is the NFP, price goes up, price finishes down, and only till the 8th of February, that is when price went back up. Touched our trend line, shadows, back down. What I'm trying to tell you here is that don't be too quick to judge something. Take your time to understand it before you start giving your own opinions and judgments and ideas. When you really understand what makes the NFP tick, or the dollar tick, or gold tick, or silver tick, or your industry, once you really know more, once you become an expert of the dollar or the euro or the pound, then start giving your judgments, start giving your ideas, and start risking more. Again, before you risk, earn the right to risk. And always remember that if you lose all of your money, you can't open a trade, but if you don't open a trade, you can't make any money. Now, this doesn't mean that you should trade every day. This means that you should cap yourself, especially if you're new. Open between 2 and 5 positions a week or even a month. Make them quality positions. Have a journal. Write down why you're doing this. You see, to become an excellent investor, you need to become a professional investor. And a professional, believe me, does not just sit there and NFP comes and says, I'm going to make money. Because if any of you follow football, basketball, or hockey, or formula racing, or anything else, you will know very well that the best people in that industry, whatever it is, whether it's sales or football or wrestling or boxing or swimming or mathematics or chess, the people that are the best in that industry is the people that sweat more than anybody else, and they do it when no one's watching. The easiest thing to do is be great when everybody else is around you, and when it's the easiest to be great. But it's what you do in the shadows that will determine how good you will be. And I'm telling you this, if you're willing to do the work, if you're really willing to do the work, you can have anything you want. That's what makes FX great. Investments. That's what makes it great. If you're willing to do the work, you can pretty much have anything you want. And the way to succeed in the investment world is to better yourself. But you need to better yourself for you or for somebody that's important to you. But what I'm telling you right now is there is a lot coming in the market. Do not rush. Even this here does not indicate anything that price will go up. It also does not indicate that price will go down. Become so good at judging scenarios that you're going to become a famous critic. When a critic comes inside the restaurant, the whole restaurant runs around for him, does everything to or her to make it great. But he's good because he's not just like the rest of the sheep herd. He doesn't follow everyone else, or she. So that's what I'm trying to explain to you here right now. You need to be a bit different. You need to have a little bit more patience, relax, don't rush, don't open 100 trades, and know that your money is very important to you. Marius, thank you for coming. We're going to be ending the session now. So does anybody have any questions for me? You can ask me anything you like, especially related to business. And have a good weekend, Marius. So if you have any questions for me in regards to any currency pairs you'd like to talk about or anything else, please feel free to just shoot it in here and I will answer right now. So Pavi is saying if US dollar weakens in the long term, then would gold be an insurance against this? Yes, it will. But you guys need to also understand that the market will not always give us an easy way to make money. So if the dollar starts weakening, you even might see the gold weakens at the same time, providing uncertainty in the markets and allowing very big banks and hedge funds to make a lot of money. So again, with what I'm saying, yes, it will. It most definitely will. But more important to take with this is don't rush at it. If something does happen, planning your entry is more important than being inside the trade. Sometimes the trades that you don't take or the investments that you don't make turn out to be the greatest things, the best investments or best trades. Marius, you mean that you're basically opening a trade, and once it goes 6 pips in profit, you move your take profit to 1 pip? Is this what you're saying? Kato, thank you. Are you available for me to call you as soon as I finish with this? Okay, thank you. Good. Yes, I know, Marius. Stop loss is +1. Yes, I know. But you're doing it when you're 6 pips in profit, right? Okay, good. No, this is good because you're actually really what you're doing there is you're building up your portfolio slowly but surely. I recommend not to open bigger trades. I recommend you to eventually, when you start building some capital and understanding how the markets work, start increasing the time frame of you adding that stop loss. Lisa, in regards to next week's webinars, I'm going to create the sessions today. I'm going to be traveling back on Sunday, so I'm going to be pretty busy. But yes, I am going to create the sessions already from this week. You will all receive an email about this. Marius, you shouldn't let them run more all the time. It's good to cap in your profit, but what I'm telling you is try not to open too many positions, because if sometimes you're closing them too soon, one of them can bite you and then take a really big chunk out of you. Peter, good night and happy Friday to you, my friend. You enjoy the day or night. I think it's night there already. But yes, Marius, you're doing a great job. That's very important. Craig, are you free in about 30 minutes? Good. I will call you in about 30 minutes. Just stay on Skype for me. At least I'm going to send you an email. I didn't check my email address yet because I was rushing from meeting to meeting. So I will reply to your email, well, pretty soon. I just have 2 very important calls to make with 2 gentlemen from this session, and then I'm going to reply to you about that. But I'm really happy that you're interested in NLP. It's actually really good. Well, you see, that's the reason I don't recommend adding stop losses too close to your position. Normally, I would advise you to start doing it at about 15 pips and saving around 5. So basically, you have 10 pips to breathe. You should always let your position breathe at a minimum of 10 pips. Marius is saying that many times that the price actually hits his stop loss and then goes into the direction. But don't let that hurt you, Marius, and don't let that change the way you're doing something. Because yes, it will do this to you many times, but this is just the market testing your patience. Take it like that. Just look at it as a test, because you will realize that yes, it will happen 5, 6, 7, 8, 9 times, but that one time it won't happen. And that one time, it could have actually destroyed you or made you a lot of money. So just keep doing what you're doing. Gather some experience under your belt. I would recommend increasing that stop loss a little bit. What I mean by this is increasing the pippage of it. So when you go 15 pips in profit, or even 10. Basically double digits. Look at double digits and then move it to 1. You're very welcome, my friend. But what you're doing is really good. Pavi, yes, I can. I can, but let's do that in a private session. It will be easier. Yes. Good. I know it's early over there. How long do you have, Pavi? Oh, okay, so you just woke up. That's good. That's good. Thank you. Thank you for attending. That's very good. Thank you for attending the session, Pavi. It really means a lot to me that you're actually waking up at 5 a.m. so you can join, and this really shows. Believe me, it's my pleasure to have you here, all of you, even the people that I don't know. I look forward to getting to know. So it's really interesting for me, and I hope it's interesting for you. I really hope everyone learned something, and if I can take one thing away from this session for you to take with you for the remaining of the day or till the NFP, is really watch out. But I don't mean be scared. The last thing you want to do is be in a position and have your hands sweaty and your mind racing around and resorting to hope and fear. I told you, try to avoid these things, and believe me, you're in control of your own trading. So just as long as you're in control of your trading, you're in control of fear and hope. The way to remove those two things is to open a position with a stop loss. Remove fear by literally saying to yourself, I'm willing to take a $50 loss, or 100 or 1,000 or 10,000 or 500 or $2. And so be it. If you lose, that's it. You lost. Do not get hedged into these positions. That's the last thing you want to do. You need a big capital to hedge yourself. A big capital. I'm talking about 100,000 and up. So don't hedge yourself in these positions today. Don't rush into anything. Keep your positions small. Lower the risk by increasing your stop loss higher and lowering the position size. I thank you all very much for coming. Pavi, I'm just going to have to make 2 calls and I'm going to get in touch with you. Oh, Heather, this is your first one. Well, I really hope it was good, and I really hope that you're going to come more and that that you will grow here with us. Really happy to have you here. Thank you for coming. Beauty, thank you very much. It's really good to see you here again as well. Pavi, you can ask me all the questions you like when I give you a call. I'm sure you have many, and I'm sure that there is a lot of things that we can go over. I should be getting that agreement today as well. It's just a holiday where that lawyer is. Craig, talk to you soon. I already marked you in my book. So I'll talk to everyone pretty soon. Thank you for coming. Happy Friday. Happy weekend. See you all on Sunday when I send you an email. Yes, Beauty, I will call you too as well. I have everybody written down. Okay, so everyone, thank you very much. I wish you all the best, and see you all soon. Okay, goodbye now.